Craig Bannister, Executive Director at Pallas Capital. Craig, thanks for participating in the Inside Network's Alternative Symposium Sydney 2023.
Thanks, James. Good to be here.
Pleasure to have you. Craig, the alternatives landscape is pretty diverse, as we've heard today, many different investment strategies. So at the high-level summary, what role does commercial real estate debt potentially play in a portfolio as an alternative?
Well, commercial real estate debt, I suppose the definition of that to start with, it's loans to corporate borrowers. We're not talking about loans to mums and dads developing a house. So at that level, so commercial loans, now that could be to a corporation that is then developing, could be a residential apartment block, could be a commercial building, could be a repositioning of an existing asset. So they're for business purposes, really what we're talking about under the commercial real estate debt definition. And I think for that portfolio allocation, we've heard about it, quite a bit today. People sort of anywhere from 10 to 50%, and this new model allocation. The types of returns is driving this. The types of returns under first mortgage debt is 6%, 7% plus BBSW rates. So we're getting up over 10, 11, 12% now. That's equity style returns under first mortgage debt. Now, probably the biggest part about first mortgage debt is the buffer, the equity buffer. We are lending generally at 65% of property valuation, 35% equity buffer. If equities, have problems, if bonds have problems, the unlisted nature of this asset class protects the investor, and so property really has got to fall 35% before investors start to get impacted, and that's what's swaying investment managers now to say we probably need a little bit more allocation into this type of investment product, and taking away from the traditional 60-40 equity bonds.
There's a bit of a misconception, isn't there? This doesn't belong in the property bucket, property allocation. This is an income-bearing part of an allocation because you are lending to owners, builders and developers of commercial property.
Yeah, 100%. It's exactly that. It's a different allocation. The underlying property and the location of that property matters. So every investment or property development manager would be different as to what subset they might play in. At Pallas, we've stayed very true to a development ethos around Sydney, Melbourne, Brisbane, developing inner city areas. We're not lending in country areas. So each manager will have their nuances and where they want to focus and where their expertise is, certainly at a credit level for the underwriting of these loans.
How many opportunities do you see, or how many are you seeing coming through at any time, and how do you process those and filter them down to A, the ones that make investment committee, and B, the ones into which you actually participate?
It's a lot. Pallas will originate over about $1 billion this financial year. Put that into context, that's probably 10 to 12% of potential loans that we could lend against. We actually originate and approve. When you then take a little view out of that, the commercial real estate debt market in Australia is a $375 to $475 billion market. They're APRA numbers. The residential market that the Big Four play in is a $10 trillion market. So it gives you some size. It's still dominated by the Big Four banks. They do 85% of the lending in the commercial real estate debt market. But the growth is happening from the non-banks coming into play, where the banks are lending at very, very conservative levels, 50% LVR. We play in the 50 to 65% LVR range. And that's enough of a space where we will grow substantially in the next 2, 3, 4, 5 years. And then the final thing I'd say is in Australia, the Big Four banks dominate with 85%. Europe, the mix between non-bank and bank is about 35% non-bank. And in America, that non-bank sector is over 50% of commercial lending. So I think we've got a long way to go in Australia. And that growth will come from offshore investment managers coming in. We've seen some of that already by some transactions that have come into the space. Investment managers like ourselves are attracting capital from offshore. That money is being deployed into the Australian market and will continue to do so. I think it's, for a couple of reasons there. The offshore managers have said they look at the Australian commercial market as a relatively stable market. There's a great legal backing, and if it's offshore money, it can easily be FX hedged, and there's no issues about cross-border.
Obviously, we've seen interest rates reset higher very quickly. What impact has that had on your market?
Yeah, it's nuanced. You would look at that, especially in the construction market, to say there's many projects now where the feasibilities don't stack up. We've had a double whammy there, of course. You've had interest rates going up. You've also had cost pressures going up. So for a lot of that, the underlying asset class, where it might have made sense 12, 18 months ago to originate that loan based on a profit on cost forecast of 15 to 20%, that margin may have gone. It may be down to 0.5%. So as a lender, that loan doesn't get originated. So now we're seeing that catch up a little bit. Property prices have caught up and may make new highs next year from where they were pre rates going up. So it's a cycle. It will come through, but definitely the interest rate environment has made it more challenging. Certain projects have not got off the ground. And in a way, we're getting this perfect storm where we need more housing in Australia. It's widely documented. But how do you get these projects started? And it comes back down to the feasibility. If costs are too high, funding costs are too high, then they can't start. So you've got to get the balance right.
In the event of a property company struggling to repay its debt to Pallas, what protections do your investors have in respect of their capital that they've put with you?
Yeah, well, each loan that we originate to a borrower, it's almost a tripartite security agreement. We own the mortgage over the land. We have that on title. We then have a company guarantee against the borrower, certainly the space that we play at, the $2 to $20 million loan space, and then a personal guarantee over the sponsor as well. So those three things, the first one is obviously the mortgage. So if there is a problem with that borrower and now we see that there's a real problem, they're slow to pay or they can't pay, we will step in. We'll appoint a receiver or a mortgagee in possession type sale occurs and we sell the property. And we've done that 4 times through our cycle since 2016. And those occurrences, they're over and done within 3 months. It's not a drawn-out process. It can be done very quickly. Once we have a clear default under the contract, we can step in, appoint that manager and sell the property.
What are the greatest risks that Pallas is looking at potentially coming over the horizon in 2024?
There's always risks in the sector, and I suppose it comes down to an individual loan approval process, looking at each borrower on its own merits, analysing that. I don't think we're going to see higher rates from here. I think rates are starting to plateau and potentially falling into next year. So that is a little bit less out of the system, a little bit air out of the system. It lets everybody breathe a bit easier. So it does come down to the underlying borrower, the credit quality, from that borrower, and just analysing that carefully before you do the loan.
Commercial real estate has a lot of people worried, particularly in North America. But are there any similarities in Australia with some of the refinancing difficulties expected in other markets?
Yeah, I've seen that. It's a sector that we don't play in, but certainly office space, B and C grade office space is difficult, and that will play out in ways. But I'm sure there will be some issues there as well. Some of those fund managers that have got a lot of exposure to that. What do you do with these assets? You can't get them refinanced. Rentals are not going up in those buildings. They're stagnant. The valuations are being challenged. It's a problem. How will they reposition those assets? We've talked about the CBD coming through and try to reinvigorate the CBD with residential sort of coming into unused office space. It's a big change, and it will cause problems. So how that plays out will be it'll show up. But
you're happy to be out of that sector.
I just don't want to be playing in that sector. Yes, very much so.
Craig Bannister, Executive Director, Pallas Capital, thanks for participating in today's Alternatives Symposium for the Inside Network.
Thank you very much. Cheers.